Meet Helga. She's 35 years old and earns $75,000 a year. Recently, she discovered something that could transform her modest 401k into over $2 million by retirement. This isn't about chasing crypto, gambling on stocks, or quick schemes. It's all about 5 Fidelity ETFs. 5 simple building blocks that even seasoned Wall Street professionals lean on for long-term wealth. Most think retirement investing is complicated. Thousands of options lead to analysis paralysis. Decades of wisdom have distilled into these funds, working like a perfectly orchestrated symphony. These aren't random picks. They are carefully engineered to balance growth, income, stability, and global opportunity. By the end of this breakdown, there will be a crystal-clear roadmap that anyone can implement with their next paycheck. Let's start where any solid portfolio begins, with protection against market storms. When people hear bonds, they think boring and low return. But bonds protect, provide income, and serve as seatbelts in turbulent markets. Picture 2008, with the stock market crashing. Quality bond funds didn't collapse. They went up. FBND is like an insurance policy for retirement accounts, providing steady income with a current yield of about 4.5%. For every $10,000 invested, it generates around $450 a year in passive income. The real magic of FBND lies in its diversification. This is not the old-fashioned government-only bond fund. FBND holds around 4,300 different debt securities. About 1/3 are government bonds for stability. Another third are corporate bonds, which deliver higher returns, and there's a sprinkle of high-yield bonds. The team behind FBND isn't passively sitting back. They are actively managing exposure across the bond market. FBND has almost $20 billion in assets under management, with a low expense ratio of just 0.36%. FBND cushions the portfolio when equity markets stumble and generates reliable income. It's the stabilizer for retirement investors. Many investors dismiss bonds as the dull cousin of stocks, yet history shows they often carry a portfolio through turbulent times. Think of them as the sturdy foundation beneath a house, not flashy, but essential for everything else to stand strong. Without that stability, market downturns can shake confidence and push people to sell at exactly the wrong time. Fairband acts like a shock absorber, smoothing the ride when equities hit rough patches. Bonds also provide liquidity, meaning if unexpected expenses arise, there's a dependable source to tap. FBN's structure makes it even more reliable by spreading exposure across thousands of issuers and sectors. Retirement investing is as much about managing risk as it is about chasing return, and bonds fill that role beautifully. Without them, portfolios feel like cars without brakes, fast on the highway, but vulnerable when the road gets slippery. If FBND is the shield, then FELC is the sword. This fund delivers millionaire-making returns while most stress about volatility. Think of it as having advanced analysts select the strongest 200 companies in America, packaged inside a single ETF. Since inception, FELC has posted an average annual return north of 23%. Investors have significantly more wealth. What's driving those results? The secret sauce is quantitative analysis, screening for exceptional fundamentals. With only around 210 carefully chosen holdings, the fund managers ensure a deliberate focus on quality over quantity. ELK stands out for being both actively managed and cost-efficient. It charges just 0.18% in expenses, a rock-bottom number for its strategy. Despite a challenging year for markets, FELC managed a return above 16%, proving its strategy withstands turbulence. In a retirement portfolio, FELC serves as a compounding engine, capturing the power of America's largest companies. FELC bridges the gap between passive and active investing, filtering out weaker performers while broadening exposure. This strategy allows investors to avoid gambling on stocks or paying high fees, ensuring each dollar works harder. FELC is about disciplined, sustainable wealth building, tilted toward proven leaders for greater confidence and higher returns. There's something deeply satisfying about receiving steady paycheck from investments, and that's where the Fidelity High Dividend ETF, ticker FDV, shines. Imagine holding companies like Microsoft or JP Morgan Chase and receiving quarterly payouts simply for being a shareholder. With FDV, that's the reality. It focuses on large and mid-cap stocks with strong dividend histories. Many are dividend aristocrats, paying consistently and raising payments year after year. With more than $6 billion under management, FDV boasts a dividend yield of just over 3%. A $100,000 investment turns into about $3,080 of annual income, and reinvesting those dividends compounds your wealth. FDV has delivered over 12% in one-year returns and around 14.5% annualized over 5 years while maintaining reasonable diversification. The fund holds roughly 120 stocks, avoiding overconcentration with about 31% of assets in the top 10 holdings. FDV provides consistent income while capturing equity growth, like planting an orchard that bears fruit each season. With stability from FBND, growth from FELC, and steady income from FDV, the foundation of the portfolio is strong. Dividend investing offers a psychological boost as it creates a sense of progress with cash deposits each quarter, promoting focus on tangible income. FDV includes financially disciplined companies, helping to reduce risk while promoting growth, thus building a system of reliability. Technology is not just a sector anymore, it's the backbone of the modern economy. FTech gives investors front-row seats to the digital revolution. FTech delivered returns north of 28% over the past year alone. It's averaged more than 23% annually over the last 5 years. These results are due to capturing innovations like artificial intelligence, cloud computing, semiconductor breakthroughs, and technologies that haven't even been invented yet. FTech tracks the MSCI USA Information Technology Index, providing exposure to roughly 300 companies, including giants like Apple and Microsoft. These big tech firms are shaping the future of civilization, from AI systems revolutionizing healthcare to cloud platforms powering global commerce. This fund captures the technologies that make everything from smartphones to electric cars possible, the beating heart of progress. FTech charges an expense ratio of just 0.08%, which is practically free for the technology exposure it delivers. Over the past decade, the fund's average annual return has been around 20%, turning modest contributions into significant wealth. FTech balances stability with explosive potential, ensuring that retirement portfolios grow with the global economy. Technology drives nearly every industry, making funds like FTech essential for investing in the infrastructure of tomorrow. FTech isn't just chasing trends. It secures a piece of the innovation pipeline and ensures broad participation in digital transformation. The last piece of this 5-fund strategy is the Fidelity Enhanced International ETF, ticker FENI. This fund unlocks the power of global diversification. Since inception, FENI has averaged over 22% annual returns. But beyond performance, its role is critical. When U.S. markets stumble, international markets often shine, and vice versa. That natural balance smooths out volatility and creates a more resilient portfolio. FENI invests in developed international markets outside the U.S. and Canada, using quantitative models to identify opportunities across countries and currencies. It currently holds over 300 companies, including global leaders like ASML, Novartis, and Rolls-Royce. With more than $3.5 billion under management, the fund delivers both growth and income. It carries a dividend yield of about 2.5% and posted nearly 20% returns in the past year alone. Its active management approach helps it outperform passive international benchmarks by smartly allocating across regions and sectors. Exposure to international markets also means currency diversification. When the dollar weakens, global holdings gain relative strength, providing a hedge against domestic risk. It connects investors to industries where different regions excel. Europe in renewable energy and luxury goods, Asia in manufacturing and technology hardware. FENI ensures that retirement portfolios aren't overly dependent on one country. Instead, they ride the growth of the global economy as a whole. Global diversification helps investors capture growth stories they might never hear about otherwise, pioneering breakthroughs in renewable energy, biotechnology, and advanced manufacturing. Owning FENI means having a stake in global innovators without navigating complex regulations. It's like holding a passport to worldwide opportunity. This kind of global exposure ensures a portfolio isn't limited by the success of one country, but benefits from the progress of the entire world economy. Helga allocates her retirement savings across 5 funds. 30% goes into FBND for stability and income. Another 30% flows into FELC, sparking powerful growth. 15% is set for FDV, the personal dividend paycheck that compounds quarterly. 10% goes into FTech, capturing the technology revolution. Finally, 15% invests in FENI, opening doors to global opportunities. Starting with $25,000 and contributing $500 a month, Helga could accumulate over $2 million in 30 years. Redirecting $500 a month can establish lifelong financial freedom without depending on one sector. The strategy is elegant because it covers every major base without drowning investors in complexity. It's simple, it's efficient, and it's powerful. These 5 Fidelity ETFs are not just investments. They are building blocks for financial independence, wrapped into cost-effective packages. The beauty of this strategy is its balance: growth and stability, income and innovation, domestic strength and international opportunity. Put together, they create a roadmap that takes the guesswork out of retirement planning. Every month delayed in starting this journey costs thousands in future wealth. Time is the most powerful force in investing. The earlier consistency begins, the more extraordinary the outcome becomes. Financial freedom isn't about chasing trends or timing the market. It's about building a disciplined plan and sticking with it. These 5 Fidelity ETFs make that plan accessible to anyone, whether starting with $100 or $100,000. The best time to plant a tree was 20 years ago. The second best time is today. A future self living stress-free in retirement will be grateful for the decision made now. Set up the portfolio, commit to consistent contributions, and let compounding do the heavy lifting. Be sure to subscribe, hit the notification bell, and join the community for financial strategies